give people too much credit as usual, Sean.
I'm a believer in people, JC.
Well,
Some people. I'm a believer in the Buffalo Bills, baby.
hey guys, JC Parets here, founder of AllStarCharts.com, and I am joined once again by my esteemed colleague, Mr. Sean McLaughlin. Sup, Shawnee?
What's up, JC? How you doing, buddy?
Oh, just watching the market bounce up and down. It goes up, it goes down, it goes up, it goes down. Some, the indexes aren't making much progress. Some stocks are going up, some stocks are going down. A whole lot of stocks aren't doing anything. So that's what I'm seeing. So when there is a lack of direction, I should say, why not continue to bet that that's going to stay the case?
Hey, man, our colleague Straza said it best to me privately yesterday. He said, I could show you some charts where there's some breakouts happening, but they're going to fail. This is a tough market.
A lot of breakdowns are failing too, right? So you're getting those whipsaws on both sides. Seems like, and volatility is very elevated. So if volatility is elevated, we want to be collecting some premium. So that's exactly what we're doing here. So the way, and I think it's important for people to, understand the thought process. You're like, JC, you were telling the whole team, not just me, like what's the ETF that just is lacking any sort of directional trend? And Straza took the words right out of my mouth. He's like, what about healthcare? And I was literally thinking that, and when you look at this range-bound market, sure, it's held up relatively well. A lot of sector ETFs don't look like this. This is one of the stronger ones, no doubt, but really no trend, just sideways. So we're selling out of the money calls, selling out of the money puts, right?
Yeah, well, you also asked me when we were talking about setting up this trade, you said, well, where does healthcare rank on the volatility list? And I'm like, well, it's kind of the middle of the list. But the thing is, they're all high right now. There's so much implied volatility, so much premium across the board right now because there's a lot of indecision in the market. So it's, basically anything we want, we could sell premium on it as long as we find something that has some good, potential for sideways action. And by the way, we should also mention we're sticking with ETFs here as opposed to looking at some individual stocks to do this in because we have earnings coming up over the next couple of weeks, a lot of earnings reports. And I don't know about you, JC, but I don't like being short undefined risk heading into a earnings report because, I've seen some horror stories when that happens.
Yeah, no doubt about it. I mean, you're just that sort of event risk is just not worth it, especially if you're naked short, right? There's just no need for that. We mitigate that risk, in depending on what our strategy is, but generally we can mitigate that risk by being in the ETFs, right? And that's exactly what we're doing here, especially as we're going into earnings season, because we did talk about some individual stocks and you're like, oh, it's got earnings next Thursday. We looked at transports have been hanging in there. Okay. So we looked at maybe something like a CSX, some other transportation stocks and, because of earnings, it just wasn't worth the risk. So I think we all agree on the healthcare. It makes sense. Sell the 130 calls, sell the 115 puts. You want to walk through sort of why November, why these particular strikes? Sure. Kind of shed some light on that.
Well, as far as the reason we chose November is I like to be in the window where I have a minimum of 30 days to expiration, as many as 60 days. So in that window. So basically like 1 to 2 months out. And so that's where the November options are right now. We have about 6 weeks until expiration, maybe 5 weeks. So kind of right on that sweet spot. And the reason why we do that, JC, is because once you get into 45 days expiration or less, that's when you start seeing theta decay, the value of the options start to more rapidly decrease with the passage of time. So, we can go sell options that expire 7 months from now and take in a big premium, but they're not going to do anything for a long time because there's just not a lot of decay when you have that much time till expiration. So we're doing November. I chose the 115 and the 130s because the options market right now, based on the price of, the loose math here is based on the price of the at the money straddle, which would be buying the at the money call and at the money put. that is pricing in a move of somewhere between approximately 115 on the downside and 130 on the upside from now until options expiration. And when you look at that chart, I love the look of that, especially those 115 puts. I mean, that's a long way down. It feels like it's got to get through that recent support from a few weeks ago, as well as that support back in March. So it would have to do a significant break for those 115 puts to get into the money. And the 130 calls just feel sufficiently far away as well. Now, as far as risk management goes, yes, we have all the way down to the 115 put to get out, but we're not going to wait for it to get that far. If we get a break below those early June lows there around 118, if we break below that, that's my signal that we're wrong. This thing is not range bound. I want to get out. And depending on the timing of that, depending on how close we are to expiration, even if we break below 118 and we close there, we might still profit in the trade. It'll just kind of depend on the timing. I'm not betting on that. Will probably be a loss, but it'll be manageable.
Yeah, on the risk management side, the fact that we can still, manage risk and take a profit while doing so, and that's certainly in the realm of possibilities. I really like the sound of that. I really like just in general having the risk very well defined. I'm a huge fan of that. I also something when you're putting on this sort of trade, the probabilities of success are on our side, right? So this is a higher probability outcome of success. It's not going to, change our lives in terms of such a grand slam win. But when, volatility is elevated, as we like to say, there are dollar bills sitting over there on the sidewalk. It's up to us to go pick it up or not. This is sort of how I look at these sorts of strategies, right?
Right. These are not home run trades. We're not going for big profits here. We're just going for high probability profits. And when you have a high probability of success, the options market's smart, right? They're not gonna give you a huge reward to take on the risk of a trade that has a high probability of success. It doesn't work that way. You get rewarded on the trades that are the long shots, right? But this one has a high probability of success. So it's a small profit if we get it right. I mean, not an insignificant profit. We collected $250 to put this trade on today, by the way, JC. So we collected $250. I think it's still trading there right now. We put this trade on a couple hours ago. And our plan is if we could buy it back for half of what we collected, so buy it back for $1.25, we will do so. I have no interest in holding this position all the way until November expiration. At that point, gamma risk becomes a problem. Your P&L swings can swing all over the place as we get closer to expiration, good and bad. And we don't want that. We want to just take the cream off the top, as they say, and let somebody else sweat out those last nickels and dimes.
And I really like putting in the resting order right away, right? So just to be clear, we're selling an XLV. This is the healthcare ETF, selling an XLV November 115, 130 strangle for approximately $2.50 in a net credit. That means we're going to be naked short an equal amount of the 115 puts and the 130 calls in November for XLV. So as soon as we're entering that order, we also want to enter a resting order, right, to buy to close this particular strangle for $1.25. So, sometimes I can go look and be like, when I see it moving in my direction, have we gotten hit? Oh, we're about a dime away. And then I'll check the next day and we got hit that morning or the prior afternoon. So it's one less thing to have to worry about if you have that resting order. Just let it dance, let the market do its thing. And if you can get filled at that price because it's just sitting there good till canceled, I really like doing that at the same time that we first enter the order, right, Sean?
And you got a great real world example of that just recently. You were short naked puts in Berkshire Hathaway, and you had a good till cancel resting order to cover your short at your price. And you got your price, and it traded at your price for maybe 10 minutes. And it has not seen that price ever since. So
I would have never gotten it. If I was manually entering and watching it, I would have never gotten that fill.
That's right. So that's exactly why we put those good till cancel orders out. Because, hey, we're not all staring at our screens all day long. Or even if we are, we're busy doing other things, taking meetings, making phone calls, making other trades. Who knows? Making
other trades. Right, exactly. You can't always be paying attention. So use that system. I mean, they exist for a reason. I find it incredibly valuable. I appreciate the insights, Sean. Again, selling the XLV November 115, 130 strangle for approximately $250 net credit. If we could buy it back for $1.25, we will. And that means, again, we're going to be naked short an equal amount of the 115 puts and the 130 calls for XLV in November. As always, I am JC Parets, joined as always with Sean McLaughlin, Chicago Sean. Hit us up, follow him at Chicago Sean, follow me at All Star Charts. I'll see you next week for another options trade of the week.